First deal we have today is in the Atlanta submarket, or Atlanta MSA, I should say. Tier 1 deal. This is a marketed property, a 2000s vintage property, currently owned by the lender. So a situation where the sponsor lost control of this property, likely due to inability to refinance. So looking at the demos on this property, we are looking at mid-70s household income, and pretty strong population growth over the last 5 years of roughly 5% year-over-year growth. Income is good. Schools are 6 out of 10 on average, so that clears our threshold. Renter occupieds are in that 30 to 40% range. Vacant housing below 10%. Median household value is below 200. So that's a little bit of yellow flag, may indicate something about the area that is depressing household value, especially relative to income. So we want to keep a close eye on that. Otherwise, and if we look at this particular area, there aren't a ton of households in this area. So this could just be a good income, affordable place to live, which isn't necessarily a bad thing, but it can be a struggle because we're obviously then competing with household stock. Going to underwriting here, this particular property was purchased by the lender at essentially what looks like the net debt, but that net debt amount was about $165,000 per unit. So that's pretty darn high. Even for a 2000s build, it's about $140 a square foot. On a price per square foot basis, not so bad, especially given the vintage, because we're looking at pretty large unit sizes. This property is currently performing right in the middle of the pack so far as the comparables. So we're not looking at a massive value add. Our expectation is a little bit about 20%, kind of on the low end of our revenue expectations or targets typically. The unit mix is strong, mostly 2s and 3s, running around 70% of the property. All units are relatively large. We've got most of our 2 beds have 2 bathrooms and all of the 3 beds. So that's really attractive, really good for families. A lot of different unit types of this property, which can be a pain. This particular property, given that it's owned by the lender, it's going to clear, I presume, the market, probably, whatever that market price is. However, given some of the issues with the expenses here, it's going to be very difficult for us to get to the right number or the number that makes sense for us. Also, financing this can sometimes be a challenge. In particular, the real estate taxes here are running a little under $5,000 a unit, presumably due to the really high purchase price previously. Going forward, we are expecting that to go down. However, given that we would look to finance this through agency, sometimes it's difficult to get them to agree to that. So that may be an issue on financing. Either way, we're about 20% off of the ask here, which is roughly their basis, which just happened this year. So that being said, we have to be about $8 million off their target price. And we will make an offer and see what happens. But generally speaking, given how far off we are, I imagine we won't be able to get in striking distance of the winning group here. Otherwise, cash yield in year 1, a little over 5%, 13% average cash yield over the life of the loan, over the life of the hold period. But again, that's at our price. At the seller's asking price, we're looking at a going in T3 cap under a 4, a yield in year 4 of a little under 6%, cash on cash in year 1 of 2%, and an average cash on cash under 6. So all those things are very much below our expectations and investor expectations. Additionally, our basis per unit would be roughly $190,000 per unit. That's going to be a little rich relative to what we want to have for a vintage apartment in this area. It is a newer property, but it's still old enough that we can't draft off the new folks, and we have to be comparing ourselves to 80s and 90s vintage properties. So that being said, we'll track this, we'll make an offer, and we'll see where it goes, and go from there. All right, so this one, we're going to bring ourselves over to Florida. This particular property is in the kind of panhandle of Florida. We've actually looked at this deal previously when it was off market just a little while ago. It's a 90s vintage deal, tier 1 for us. It's currently being marketed now. So we had previously offered, but now it's a marketed deal. Obviously, we were not successful in our previous bid. This particular deal, demographics wise, we're looking at an average income between $60,000 and $70,000, household value between $200 and $250 for the 1 mile radius. The population growth in this area has been flat to slightly negative. Unemployment rate looks strong. Schools are at the borderline. So I would say on this property, we don't want to stretch too much because the demographics are okay, but they're not excellent. So from there, we'll go over to our analysis here. This property was previously purchased in 2021 for $155,000 to $160,000 per unit. And looking at this property here now, we're mostly looking at, it's an all 2-2s. It's a smaller property, only about 100 units. And the pricing has increased from when it was off market. We're looking at about 15 cents off of what the seller ask is. So yeah, they're looking for what doesn't seem like a horrendous going in cap rate, a little under 7%, but the expenses on this property are extremely low. We'd be looking to increase expenses by about 30% or over $200,000 per year. So when you really look at it on a adjusted basis, we really want to look at what is our yield in year 4. And in order to get to a mid-7s cap yield, which is where we want to get to for our deals, we really have to go in at over an 8 cap just based on what the seller's financials look like. All in all, we're about 15 cents off the seller ask here. The property right now is really strong so far as occupancy, running 97%. Almost no bad debt of any sort here. And the value add is pretty decent. It's about a $200 lift. Let me just take a quick look. It's about a 15% revenue increase from existing to our goal. So not a huge amount of revenue increase here. So the only reason we're getting, the return comes from the in-place NOI, the in-place cap rate, and that's pretty much where we're driving a lot of value. But again, given this is marketed at this point, and given that they are looking for a lot more money than they were just a month ago, sometimes that happens. Sometimes, especially when you work with brokers, they will tell you a price that they can get you because their whole goal is to win the listing. Once they win the listing, you're trapped in the process, and then the market will dictate your pricing. And then the hope is that the owner will move forward and capitulate to the market price. But this is something that we do see frequently, where properties might come out at what we think to be very high prices. That being said, frequently these deals get done. They may not get done at the ask, but I wouldn't be surprised if this deal gets done somewhere around 95 cents on the dollar for someone who maybe has an existing property in the area or has a compelling and bullish case for this particular area in this type of deal. That being said, we're going to track this. We like this opportunity. We had bid on it when it was off market, and we will keep tracking it until it trades. Okay, next one we have is in South Atlanta. We're typically not very constructive on South Atlanta. If we are buying in the Atlanta MSA, we want to be mostly north of the center city, in the suburbs primarily, or we want to be in ex-Atlanta, given South Atlanta is riddled with a lot of bad debt. Tenant classes doesn't have as high of income, and then the home values are not as high, and the schools are not as good. So just for all those reasons, it's just a better area for us in the northern part. However, this particular deal we've seen a few times over the last little bit. It's been trying to trade for a while. And again, usually that's a function of the location and some of the issues due to that. So looking at the demos, this one has an income of about between $55,000 and $60,000, which is just around at our threshold. But the household value, and this is an important factor, is $125,000 a house. So at that price per house or household value, it's very compelling to just buy than it is to potentially rent. But going after that, we want to look at the renter occupied housing. We're looking at almost 50%. So that's another thing to be considering. These are all signs that we're probably not in the right area. This particular property also has schools that are below the threshold. So elementary school is a 2, middle is a 5, high school is a 4. Again, these are all issues for us so far as demographics. So it's really only something we would want to buy at an extraordinary discount, do the value value add and move on and flip it. We wouldn't want to hold it long term. That's really against our kind of core philosophy. Looking at this deal, yeah, we last saw this one about 2 years ago and we bid on it a number that's actually higher than where we are today, just given that this property doesn't seem to be improving necessarily, but seems to be degrading in some capacity. Vacancy wise, we're looking at about a 90% occupied property. I see no bad debt in the T12, but that is not a function of the fact that there is no bad debt. It's probably just the way that they're running their financials. We'd have to dig in more. Usually what happens when you see no bad debt in a T12, either they're not charging off and they're holding that on their AR report, or they're just showing you cash collections. They're not showing you accrual accounting, and then therefore you're getting a different view of the financials. And that's typically not meant to trick you, but it's meant to make the T12 look a little bit better, at least at first glance. So all in all, when I look at this property, they're currently running at about $1.20 a square foot. We think we can get to maybe $1.30, $1.35 a square foot. But again, $1,500 rents, pretty expensive for that income. And so we want to be careful about that. Unit mix is very good, mostly 2-bed, 2 baths. And we would be looking at a significantly higher payroll than the existing sponsors. They're currently running payroll almost, looks like half what we would be running payroll at. So now I imagine they're running payroll at that number because of the struggles they're having with the property and trying to maintain perhaps some cash flow. But we would need to bring in additional payroll in order to get this asset to perform. And given the area, that's probably not worth, the juice is not worth the squeeze, so to speak. And I am going to lower the price here a little bit, just because I don't think that this one is worth going after too aggressively. But at this number that I just put in, we're going to be at around a 6.5 cap going in, getting to about an 8.25 cap by year 4. We want to be very careful in areas that we really like, where we have strong demographics, good household value, good income, good property. We want to be in the mid 7s on yield on cost by year 4. However, when we're in a not so good area and we're not in quite the target that we want to be in, we need to be much, much higher on our year 4 numbers. So we want to be in at 8, 8.5 in those situations. And only in that situation would we be willing to sacrifice our buy box so far as geography, because we can get a bargain purchase and we're being compensated for the additional risk. We cannot buy at the same valuation as we can for properties that we feel are in the right areas. That being said, we will track this one. Not one that we're likely going to get. We have bid on this one before, but we'll track it and see where it trades. Okay, so here's another deal in Atlanta. This one is in central, not north, not south, so to speak. If I look at the demos here, though, not hitting our requirements. Household value is very low in the 100 to 150 range. Household income is below 60,000. Population growth has been roughly flat. Unemployment looks good. Schools are 3s and lower. So generally speaking, this is a non-starter for us. Given that this also is a property that had traded in 2022 at a very high price. Back in 2021 and 2022, you saw a lot of people buying property indiscriminate of location. When money was cheap, everyone was buying on revenue and not really considering quality of revenue, which is definitely a very important factor, especially when the tide goes out and we see that some of these properties are just not worth what they are in other areas. Looking at this, at where they're looking to trade this one at a going in cap of 4.5, which would be getting to about a 7.4 yield on cost by year 4. That going in cap would be not big, not high enough. The yield on cost would be sufficient if we were in a really target area for us, but given that this is a borderline market for us in a lot of ways because of the schools, it doesn't really hit our thresholds. We can't nearly be there. We'll be about 13-14% off the ask here, going in at a mid 5 cap, getting to about an 8.5 cap at stabilization. Basis, once we're all said and done, we'd be about 130 a unit. Again, on this one, we'd be looking to take $1.30 square foot rents to about $1.55 based on comps. If we look at the sales comps in this area, there's definitely some high flying price per unit sales. But if you're really careful about the areas that you're talking about, then there's definitely a grouping around this current price that we're looking at. About 100 a unit This particular property, I'm not sure if I mentioned, is an early 90s vintage, late 80s vintage. I think that on a price per pound basis, this 110 bucks a square foot seems attractive. But again, we've got to be careful about the location. And if we look at the bad debt here, on a T12 basis, it's between 5 and 10%, but it's more closer to more T1, T3. It looks like that's been largely cleaned up. Other income is running around 15 to 20%. That's standard, so we wouldn't expect that to move much. Insurance, we do expect to go a little higher. And then real estate taxes, we are expecting to go down given the purchase price is below the seller's basis and prior purchase price. The only other item, and something we don't typically see, is our payroll is actually lower on this property than the existing sponsor, but still a healthy $1,800 a unit. We would staff this property, it's about 200 units, with 2 people full-time leasing, 2 people full-time maintenance, and that's about what they cost these days. They may have an extra leasing person here, which might be why we are a little off on payroll versus the existing owner. Otherwise, this particular property doesn't hit our demographics. We're not going to chase aggressively. We will get an offer in at roughly 100 a door, and then we will see where it lands. So we'll go from there. All right, so next deal we're going to look at is in Huntsville, Alabama. This market has seen some oversupply, most notably in the northern area of Huntsville. This is definitely something where people get a little skittish when you see oversupply, but this is an older property, very 60s, 70s build, and it's not in the area of overdevelopment. It is in Huntsville. You have to look at every single submarket, and if you're 20, 30 minutes away from the area of oversupply, you're not really competing with that product, especially given oversupply is by definition a function of new construction, and we are looking at properties that are between 30 and 50 years old. So it's just not competitive to each other. It does soften rent growth and potentially what our ceilings look like, but we can consider that in the comp set versus being really concerned about a lease up here, because obviously this property is fully occupied. All right, so in this particular one, we've got 1 mile radius of about $80,000 to $90,000 income. Household values are around 250 to 300. This looks like a strong pocket, 1 mile radius versus the 3 and the 5, which have slightly lower incomes, slightly lower house values. The renter occupied units here are around 50%. That's something we want to keep an eye out, even though we do have pretty strong other figures here. Vacant housing units are under 10%, which is what we expect. Population growth has been really strong, over 3% compounded growth over the last 5 years. So that's really attractive, but that's also why we're seeing oversupply. A lot of people will try to move into markets where you have strong population growth, and you got to be careful because strong population growth or strong predictive population growth typically brings builders. Builders lead to new supply. New supply does not necessarily equate to strong rent growth. So normally people are trying to say, hey, strong population growth will lead to strong rent growth. But if you can't predict what your supply risk looks like, then you're going to have a little problem. So a lot of people have been burned by that in a number of different markets, from Austin to Huntsville to some parts of Florida to the Atlanta area to Houston, places like that, and other areas around the country as well. Okay, school-wise, it looks pretty strong. Elementary school is 9 out of 10. High school is 8 out of 10, 7 on average there. Crime looks good. So this is a good area, at least at first glance. Obviously, we always get boots on the ground and make sure that we agree with the numbers say on the desktop, but it looks pretty strong at first glance. This was a deal that was completed initially in 2021. The note is due in the winter, so in just the next 3 to 6 months. They purchased this property for about $125 a unit in 2021, which would have been pretty darn expensive, given that the rents today are only a little over $1,000 per unit. So it's about $110 a square foot. But for them to have bought this property 4 years ago, their probably rents were in the $800, $900 range. And so to buy at $125K a unit at $800 rents can only really be done when you have a 3% loan. Definitely maxed it out at that point at where we are today. We want to be at $90K a door, right? $95 a square foot. The demos here are good, but the vintage is quite old. So I imagine we're going to have to put a lot of money into this property to deal with physical improvements that are not value add related, not NOI driving. So I'm talking electrical, plumbing, foundation work, roofing, amenities, drainage, probably dealing with cast iron pipes and other issues that we have to deal with, which doesn't necessarily do anything but increase our basis. It doesn't increase our NOI. So all in all, once we're all said and done, we are looking at almost a $20,000 a unit budget for this property. From a CapEx perspective, we would be somewhere just south of 120K a unit on this property. For this one going in, we do want to be an agency financing out of the gate. That does limit what our pricing looks like, but it also leads to good yield. So we've got a little over 5% yield in year one cash on cash, moving to 7 to 8% in year 2 and 3, with almost a 13% average cash on cash over the life of the property. He's got a 10% other income as a percentage of total rent, which is pretty strong. The vacancy here is relatively high, which is a little bit of a problem in the event that we go agency, which is what our go-to plan would be. We're looking at about a 10% vacancy factor. Anything over 15% in this deal will not pencil for agency. So we've got to be very careful about that. But that may just be a function of poor operations here. We're looking to see taxes go down, given we would be buying at below the prior owner's basis. Insurance also looking to go lower based on our master policy and based on bids from our consultants. Otherwise, everything else is bid to what we currently operate our properties at, and we are looking at about a $500 a unit increase in overall expenses versus the T3 and the T12, which is pretty common for when we come into a deal. Very infrequently do we see our expenses lower than the prior owners. All in all, we also are looking at this property to do about a 20 to 25% lift in revenue, which does make sense given what I see for the income in the area and what I think we should be able to achieve so far as rents here, which we get to a little under $1.30 a square foot. So that's looking pretty strong. All in all, I like this deal. We do Huntsville. I think it's a little bit of a contrarian play, especially if we can go older vintage outside of the supply risk areas and take advantage of the fact that a lot of people are currently not buying in Huntsville because of those headline factors. And so if you dig in deeper, you can find pockets of value. In this particular case, this person is incentivized to sell, so they're going to sell at the market price due to their loan maturing at the price that we are at. Though unfortunately, they are not clearing the debt, so that's a little bit of a struggle. So it's going to be very difficult for them to justify moving at 17.9, 18, 18.5, whatever that number ends up being, just because the loan amount is about $1 million to $2 million higher than that. Maybe there'll be someone else who comes in and strikes a deal at the loan. At the loan, though, we're under a 5 cap, so it just doesn't really work for us. But otherwise, I like the deal. And if we can figure out a way to get around the valuation issue or potentially just work with the lender to buy it once it gets the keys go back, then we can deal with it at that point. All right, we'll keep a tracking on this one. I like this one, and we'll see if we can get a deal in Huntsville soon.